Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about NextDecade, specifically just covering their Q1 report and going through the current state of the company and what we know. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in NextDecade, so this video should be for your entertainment purposes only because I can be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So again, I'm gonna go through NextDecade. Hi, Walkaza. Thanks for hopping on the stream. Um, and so let's go ahead and get to it. So for NextDecade, obviously the big portion here is, well, let me give you the 10-second summary if you're not familiar with NextDecade. This is a company that has two wings. One of them, Next Carbon Solutions, I'm really not going to address today because we don't know what's going on. They didn't give any material update. This does not have this. This is it's like a startup more or less. They don't have a whole lot of progress. They didn't announce anything new with these reports, so not going to focus on it today just because there's not much to talk about. Rio Grande LNG. This is an LNG export facility they're building down in Texas, I believe, and so this reached its positive final investment decision last year, and it's being constructed by Bechtel right now for the first three trains, and they are looking towards train four at the moment, and then train five in the future. So that's going to be most of the focus for today. And for trains 1 through 3, these are on schedule as they, continue to be, and as you expect with Bechtel building this and getting everything in order. And so there's not much to say about this. It's on schedule so far, and the timeline hasn't changed. The timeline is all the way down here, which again, I think these timelines are guaranteed by the contract, so you'd really expect those to be pretty reliable. Hi, Transient Stacker. Thanks for hopping on the stream. So this schedule is what they are. End of 2027 for Train 1, mid of 2028 for Train 2, and end of 2028, maybe beginning of 2029 for Train 3. That is not new. The same timeline we have seen. So there's no real surprises there with trains 1 through 3, which is phase 1 of the Rio Grande LNG plant. There is a bit of I would call it FERC drama. If you read through the details of their 10Q, yeah, I have it up right here. There is a minor risk, I would say. Sorry, in my opinion, it's minor, and also in the company's opinion. But there's a risk here where there is still some appeals going on for some of the folks who were trying to get NextDecade to stop building this facility, right? And this was two technical issues dealing with environmental justice and greenhouse gas emissions. They were remanded to FERC. FERC denied that, and then they're now going to appeal for the the DC circuit. And so oral arguments, it says, have been scheduled for sorry, maybe I'm getting this mixed up. But anyways, they have something right here. It's hard when you're live, not gonna lie. But they have something here that is still ongoing, is still pending. They FERC denied the actual stay on NextDecade and Bechtel building the facility, but there's some amount of appeals still going on. Oral arguments are scheduled for this month, for I guess that would be this week, right? So that's a minor risk. I think even the company, they have the verbiage right here. We do not expect the appeal process to have any material negative impact on construction or operations of phase 1. So again, just calling that out if you do want to, do all your due diligence, that's something to be aware of. So going back to the actual results and current state of the company, notwithstanding those appeals, most of the focus here in the announcements and in their presentation is really on Train 4, as you'd expect, because that is the growth story for the company, right? They have trains 1 through 3 in phase 1 locked down. Now they're focused on Train 4, and they did not announce any concrete progress, which I think a couple of us were hoping. There's been some rumors online that they did, they basically have an SPA lined up. And then there was some other rumors. Even there was a Bloomberg story that mentioned that Pacific Energy was in talks with both Tellurian and NextDecade. And so they did not announce anything concrete. So we really don't have anything to go off of quite yet. But it seems likely. They're clearly, as I say here, and they continue to say, commercial discussions are progressing well with multiple other potential counterparties. And so there's been some other minor leaks that do corroborate that, and they're pretty credible, and I think it's personally that's part of my investment thesis that it is very, very likely they're going to at least get train 4 and likely also train 5, to a positive FID, and that's going to be the growth story for the company in the medium term. But as they call it out here, I think this is the same as it has been, but I'll reiterate it that Total has an option for 1.5 million tons per year from train 4, and that also I think is tied to the actual 10% equity stake in the financing of train 4. And then, as I put here, assuming that Total exercises that option to purchase 1.5 million tons per year from train 4, that they really only need to contract another 3 million tons per year from train 4 in order to reach a positive FID. And so, that's really not a lot considering the pace at which they were able to sign these things in, what was it, 2022, when they were signing these. It seemed like there's a new one every other month or so. And so that, I think, again, is very likely that they're going to be able to make this happen. And they also talked about finishing the EPC contract with Bechtel, I think by right here by the end of the second quarter of 2022. So 2024, excuse me. And that's in 2 months from now. So we should hopefully expect to see some announcement with that if they end up announcing it. It's hard to say. I think it's possible they will just wait until their Q2 report comes out in mid Q3 to say that we finished that up. We're going on. But maybe they'll make them an actual PR when that happens. Maybe they won't. It's really not material because I don't think there's a lot of risk in this. I think it's just sort of a necessary step before they can start to actually get the financing in place, which they think they're going to do all of this by the end of the year. And the numbers on that haven't changed with what they're throwing out for the rough model here: 75% debt, 25% equity. And still same model as before, that they're hoping to use their existing equity partners they might be too small for you to see here, but to use their existing equity partners that they used for phase 1 to also fund 60% of train 4, and then they're going to try to fund the remaining bits themselves. I think there's a slide that kind of talks about this a bit. Where's it at? This one, right? So I'm not going to spend too much time on it. You can read through this in detail by the way, this is just their most recent corporate presentation. It's available on their website. You can grab it for yourself if you want and dig through all the details here. But as I said, they have these existing partners. Total has an option for 10% of, I believe it's 10% of train 4. What is this? 32%. That's for the overall project. So this last column here is what we were looking at here. The 10% for train 4 and 5. And this is a bit different because it's talking about their potential long-term economic interest. And there's actually this weird thing. I don't think they've disclosed the details. If you read in the footnotes here, it's small. Probably can't read it, but I will try to read it to you. Basically, GIP, GIC, and Mubadala, sorry if I'm pronouncing it incorrectly, they hold options individually to participate in an aggregate of 50% of the equity funding for each of trains 4 and 5. Total is just a flat 10%, right? So that 50% plus that 10% that Total has, that's where they come up with that 60% that they have sort of options with existing partners already lined up to fund the equity portion of trains 4 and 5. However, it's for an economic interest. For those folks that are funding 50% of it, it's for an economic interest that will adjust from a total of 50% down to a total of 30% based on achieving certain returns for the investments in the respective train. Right? So basically they're saying they're going to front 50% of the money for the equity in trains 4 and 5, but they've signed the agreement such that if the return on that investment is sufficiently high, that will actually, sort of scale all the way down to an economic interest of 30%, not the full 50% to correspond to what they actually funded. So I think this is a little bit of, those are the concessions they had the concessions that they were able to get to actually, retain more of the overall ownership or more of the economic interest in the long term of this project, in return probably for getting to front the money for phase 1, right? Because this represents, a bit of a sort of, if they're getting enough from the overall facility, they'll be more than happy to give away some of the later phases, some of trains 4 and 5, assuming that they're making enough from everything they've got to that point, right? That's kind of the way that I read this here. So that is Again, that's not new, just reminding you if you weren't familiar with that, but that's also goes into their actual next decade's projections for their cash flow numbers. And these for trains 4 and 5, part of the reason why these numbers are so much larger than what they're getting for trains 1 through 3 is because of that fact right there. And it's down here in the footnotes. They basically say we're assuming for trains 4 and 5. Where is it? I can probably find it right down here. So these numbers based on, yeah, so they adjust from 50% down to 30%. I think these projections, they say they assume the financial investor's economic interest has been adjusted to 30% based on meeting the threshold returns, right? And so I think they're already saying that to come up with these projectable numbers. So if they didn't end up meeting those thresholds, meaning this ended up not being as profitable for those investors as they as the agreement sort of set those thresholds at, which we don't know what they are. But if they don't meet those thresholds, then these distributable cash flow numbers for next decade are going to be substantially lower for trains 4 and 5 because they will be taking 50%, not the 30% from those external partners. And so next decade's ownership would then go down from what is it 40%, or from 60% down to 40%. So that is just something to be aware of. It is a risk for the company, right? To say that these numbers might end up being too optimistic, but to some degree, I do have trust in management that they're going to make the numbers work. And then this again, they're not disclosed, so I can't have an opinion firsthand. All right, going back, let me talk through liquidity, right? Because that is another thing for this company, and this gets into more of the details in the weeds with the actual financials of the company right now. They ended Q1 with $45.7 million of cash that was actually theirs. And it's really hard to read this balance sheet here and know what is part of next decade, what is part of the common equity that you and I can invest in as the NEXT symbol that we purchase versus what is in the Rio Grande entity, right? They have this nice overview here where you can see there's the Next Decade Corporation. That's what we can invest in. And then they own, Next Decade LNG, which owns part of, Rio Grande. And then we have the joint venture partners that own also part of Rio Grande, right? And so when they report this balance sheet, it's all of these things combined at the moment, all of these entities here. But, clearly Next Decade at the corporate level does not have $3 billion worth of property, plant, and equipment on its balance sheet, right? It has very, very little. It has an ownership in Rio Grande, which has all those things. And so they split this out a little bit in the further down. If you go down and look at the, there's all this stuff down here. Where is it at? Not that. Well, it's somewhere down here. I'm not going to waste all my time finding it because I already have it in a spreadsheet. But if you look down here, you can see, here it is. I think where they split out and they say, this is what we actually have in the intermediate holdings entity for Rio Grande. And so if you subtract these out, which I have done in a spreadsheet over here, you can actually get to what is Next Decade at the corporate level, what is their balance sheet. And so that's what I have here. And I even simplified it just because my purposes here is not necessarily look at their full balance sheet. I really just want to look at what is the current liquidity and the runway for this company. And that's what I'm trying to get at, trying to understand how much cash they're burning, right? Because you can also look at their statement of operations, but it's kind of hard to see. You look through this, it's a bit hard to tell how much of this is a cash expense. And then you go down and look at the statement of cash flows. That includes all of the Rio Grande stuff in there. So it's really hard to pick apart these things. My best approximation here, so I'm being long-winded just to explain to you the process that I'm going through. My best approximation for how much cash they are burning is to look at this difference in their balance sheet from, the end of the last quarter to the end of this quarter and say, how did their cash change, and look at a couple of the other balance sheet items. And so I subtracted out all the Rio Grande items to try to get just the Next Decade balance sheet. And then I'm looking here at their cash, their prepaid expenses, their accounts payable, and then some of these other liability items. Just really these 4 rows here. Operating leases. I put this here just so I could take a look at it. But the rest of it doesn't really matter. We know that they have debt. I'll go through that in just a moment. But that is this is sort of the current. Well, I should talk about the debt right now because it is relevant for their runway. So let's talk about that just really, really quickly. I think they even have a slide for this that notes it. Slide 6, I put a note for. So they did get this $50 million senior secured revolving credit facility with additional $12.5 million that they can borrow to cover interest on that. So basically $50 million they can use to fund the company. However, this matures, they have to pay it back when they actually make a positive FID on Train 4. Either the earliest of that or 2 years from the closing date. And clearly they're trying to FID on Train 4 within the next 2 years. So we expect them to have to do something when they actually get that FID on Train 4. Probably a large equity transaction where they sell a bunch of stock. We'll talk about that in a couple of minutes when I talk about sort of the discounted cash flow model. But they got this money. This is how they're funding the company right now, right? They're not directly diluting at the moment, not massively, not to fund the company. They are pulling down from this revolving credit facility in order to fund the NextDecade at the corporate level. And so I looked at this to say, okay, quarter over quarter, their cash position actually grew. It's because they drew from some of that debt, and you can see their debt went up from $0 to $25.6 million. And in total, they borrowed, I think, 26.9. I'm rounding it, $26.9 million. Again, these are in all of these numbers here are in thousands, just because that's how these things are reported on the 10Q. I copied it out of there. Sorry, I could have made it a little more clear to make these add the 3 zeros on the end, but just add 3 zeros on the end of pretty much all these all these dollar values here, so these are in when it's 7512, that's 7.5 million, not 7,512. So we looked at, they actually went up in cash during the quarter by $7.5 million because they borrowed $26.9 million. They also increased their prepaid expenses, meaning more cash went out the door than really needed to, right? If we were trying to adjust things out. Same with their liabilities actually decreased. Again, I think maybe this is not a good thing for me to do, but I sort of figure if this was an acceptable amount of liabilities for them to have, figure it could go back up to that. So if we adjust out those things that were kind of balance sheet items, that would get us to an adjusted cash burn of $14.5 million per quarter. That at least gets us in the ballpark. Again, you could decide whether for yourself if you think it makes sense to net out these things or not. If I just took those away, made them zeros, that would get you closer to a 19, maybe even round it up to $20 million per quarter cash burn. But if I used my actual adjusted figure here to look at what was their actual cash burn for their operations, that's my kind of rough guess here. Then you get to this, and again, at the end of Q1, they had $45.7 million in cash. They have about $35.6 million remaining that they can pull from that corporate credit facility. And again, this to some degree maybe is a slight overstatement, because part of that, what they can draw, is for interest expense versus just the actual kind of principal of the $50 million out of that 62.5. But again, this is just to get a ballpark number anyway. So use that full figure here of their remaining amount that they have under that corporate credit facility, and that gets you to total liquidity that they could have between their current cash and that corporate credit facility of about $81 million. Divide that by this $14.5 million figure here, and that would get you to 16, almost 17 months worth of runway from the liquidity that they currently have right now. And that is actually a pretty good amount of time. Again, let's say if you wanted to kind of net some of these things out, and you say, well, maybe I'm going to be slightly more pessimistic, figure it's more like $20 million per quarter. Really, this is 19.4. Even if you use that still gets you a year's worth of runway. Again, the beginning of this either 16, 17 month figure or the 12-month figure is the end of Q1. So that would get us through to the end of Q1 2025, or maybe into the middle of 2025 with the current liquidity that they have. So I think that is consistent with their desired timeline for getting their FID on Train 4. That they can, if they could get that done by the end of this year, or even if it slips into Q1 of next year, they have the liquidity to make that happen. If it stretches very much further than that, then we're gonna have to be looking at some other debt or equity transactions going to help fund the company in the interim while they have nothing. And even still, even getting the Train 4 FID is not going to get them any revenue to help fund the company. There's still going to be issuing debt or equity in some form or fashion. But my my speculation here, as I think I mentioned my last quarterly update on NextDecade, is, because they've said that they want to fund, NextDecade is exploring options to fund the remaining 40% of the equity for Train 4. And they're trying to find the most accretive source of funding available. Of course they are. But, whether that's debt or equity or some convertible deal, my guess is, my rough figure, 40% of the equity of Train 1, and the equity comprises 25%. So that's, roughly 10% of the total amount of, the cost for Train 4. That's probably substantial. Again, I think I did a ballpark figure last time where that's probably on the order of, $500 million. And when we're talking that amount of money, I think they're just going to tack on what they need for funding the company with that transaction. So again, because if they need, what I say, have to pay back the corporate credit facility of $62 million, but they're raising $500 million just for Train 4 for, what they want to contribute for equity there. I have to imagine they're just going to do one transaction for, $550 million and, just do it all at one time. And presumably even larger because they'll want to continue funding the company through to the operations of, of phase 1. And the real question there is going to be, what does that look like? They said they're trying to find the most accretive source of funding available. My base case for this is that they dilute, at a share price that's, 10, 15% under the current share price as we see it today. And if that was the case, if they were able to get $6 per share with that, with sort of that dilution, that's how they fund this $500 million. That is where you're looking at them, issuing, I don't know, somewhere on the order of another 100 million shares, 80 to 100 million shares, sort of to finish up Train 4 and get some liquidity and some runway to continue on operating the company while they are waiting for phase 1 to actually be constructed. So that is sort of where I'm looking at it right now in terms of their runway and their liquidity. So as I said, if they were just paying off this revolving credit facility, it's about, you know what, let me do the math right here so you can see it. I have my notes here, but it'll be easier for you to see. So right now, this was their runway all the way through to full operations of phase 1. So they have another 3.75 years left. They are spending right now about $14.5 million per quarter. So let's call it 15. Well, let's do this in 3.75 years times 4 quarters, 15 quarters times $15 million per quarter, $225 million. They have to pay back also the revolving credit facility they currently have. That gets us to about $287 million. Just round it off to $300 million at $6 per share. That's another 50 million shares they have to issue for funding the company between now and start of operations. Then you also figure $500 million they have to have for Train 4. Divide that by 6 if they also get $6 per share. That's 83 million shares. Add that together. It's 133 million shares. They're going to have to, sorry, did I do that right? No, sorry. My notes, I was writing too much over here. I'm sorry, I'm confusing myself. So that's the amount that they're going to have to issue somewhere in that vicinity in order to actually fund the company and get their equity for Train 4. They're probably going to do something similar even for Train 5, which gets me down to my discounted cash flow model here. And this one here, I put line items. Let me go through this real quick for anybody who hasn't seen this before. I made future, cash flow numbers. This is based off of the company provided numbers all the way down here that I've already noted before. Trains 1 through 3 and trains 4 through 5 are different. So using these numbers here, put them on a yearly basis, combine that with the schedule of when these trains are actually, for trains 1 through 3, when they expect to be done. And then for trains 4 and 5, I just kind of put in my own numbers here of when those should be done. And then you're looking at, free cash flows for each year. I discount that back to the current, to the present at a discount rate 10%, or it's a parameter here, but for now I have 10% for trains 1 through 3. I put a very high discount rate for trains 4 through 5. Again, you can play with this depending on how you want to account for trains 4 and 5. Right now I have it at a very high discount rate, just so you can see what this looks like. And then that gets me to sort of a cash flow number that they get every year, between now and many years in the future. I have a small amount for the net present value at the very end of this period of it in 2048, and but otherwise I'm using their cash flows for about a 25 year period, and add all that up, and then I put in amounts for how much do I think they're going to have to dilute to fund until operations for train 4 equity and then train 5 equity. So I put these numbers in here, and then I come out with what I think their fair value per share is going to be. I also have some numbers here where, and I'll go over this in slightly more detail in a moment, on what their share price might be in 2029, then also sort of 2032, based off of their price to free cash flow metrics. I guess I should do this. I picked 2032 because I had the all 5 trains in there. Maybe I could have done this like 2033 or 2034, but the point is, this is with all 5 trains. What might the stock price be with a price to free cash flow multiple? And this is my model for NextDecade, where I come up with sort of where do I think the intrinsic value of the stock is. Let me get a drink real quick. All right, so these are the assumptions. I put in just middle of the road of their projections, $250 million per year in free cash flow from trains 1 through 3. I have their start years of 2028 for train 1 and 2029 for trains 2 and 3. I also put in a factor here for their uncontracted volumes, right? They're not actually 100% fully contracted for trains 1 through 3. They have 1.4 million tons per year that aren't versus their actual stated capacity for those for that phase 1 facility. And so, they've said, hey, we're going to sell the rest of this at spot. And so they can get sort of a better margins by selling those at spot. Figure they get $3 per MMBTU on spread there. Then, they also are going to get cash flows from that, in addition to the numbers that they put in these, distributable cash flows, because this is only based on their sales and purchase agreements that they've already signed. You can read them in the footnotes down here. So get to that amount. Trains 1 through 3, very quickly in 2029, 2030, that gets you $250 million per year for the sales and purchase agreements. Another roughly, again, with these numbers, $44 million per year from those uncontracted volumes. And, that gets you most of the value. And so let me do some numbers real quick. If I just take out trains 4 and 5, I say they're never going to make any money from those. And I take out the dilution to fund the equity for train 4, the equity for train 5. That gets me sort of, again, middle of the road assumptions, 10% discount rate, and final shares outstanding are going to be 340 million. Again, they have to dilute to actually fund the company between now and when those operations start, because they have no other source of cash. And that gets you to fair value today that is below the market price. It's somewhere around $5.29. That's at least what this model says. You might also say, maybe I think the discount rate should be a little bit lower because there's not a lot of risk in here. Put that at an 8%. That gets you to $6.54. That's pretty close to where it's trading today. Again, this is also using middle of the road numbers. If you wanted to say, hey, I think they're going to be closer to 300 million, and so I want to put that in for their annual cash flows per year. Put that $300 million in there. Even at the 10% discount rate, that again gets you to close to where it's trading today, a little bit below, but $6.20 per share. And if we were to look at this another way and look at 2029, what does the share price look like based on their price to free cash flow? If I just try to value it at that point in time, and again, this is not net present value. This is the 2029 value of the shares. If you went for just a 10 price to free cash flow multiple, that would get you to a stock price of $10.11 per share. Again, using the same 340 million shares outstanding figure in 2029, based on those numbers there. So again, gives you an idea of the possible ranges you could expect to see for the stock. And then that does give you that price appreciation between here and there. Again, roughly based on that discount rate that I'm using up here. Let me undo some of those things that I sort of zeroed out here. And then let's throw in train 4. So let's say for train 5, I probably can't really do this perfectly in my numbers, but let's say train 5 doesn't start until 2047, because that should make it not really show up here for quite a while. And we will have free cash flow for each of trains 4 and 5 at $350 million per year. Again, that's consistent with the low end of their guidance on what they're going to have for trains 4 and 5. If we look at that and get a more reasonable discount rate, let's say instead of discounting this by 25%, I think it's very likely they're going to make train 4 happen. Throw this out at something like a 15% discount rate, because there's still more risk than trains 1 through 3, obviously. But if I think it's, somewhere closer to this vicinity, you get down to that, and that gets you to sort of current fair value per share of $8.27. If I even drop this at 10% to sort of get an at train 4 FID number for this, then that gets you, closer to $9 per share. Did that change? Yeah, I guess it did change. Sorry. Ever so slightly there. And what was I going to get as? My number here for their train 4 equity, again, that's based on my figure of $500 million per for the equity portion that NextDecade is going to have to contribute to train 4. If they were able to dilute at $6 per share, that really more like 83. So maybe I could call this 90, because there's always some slippage when they actually do these transactions. They have to pay 10% in fees to whoever. So if we call this more like 90 million shares, that helps just a little bit and puts sort of the maybe a rough amount of fair value per share at train 4 FID somewhere closer to $9. And this isn't perfect, because I still have a little bit of train 5 coming very, very far in the future, but that doesn't contribute very much. This should be a pretty reasonable ballpark number. Now, if I go back and I put in, that was also assuming a start date for train 4 of 2031. That's when those would come in. And I also am only using their numbers. Here's one potential thing that is my calculation is conservative. This was using the bottom of their guidance range for trains 4 and trains 5. But it is also not accounting for the fact that there might be some uncontracted volumes in trains 4 and 5 that are also not counted in these distributable cash flow numbers. I don't think that they actually specify that in all the footnotes down here. So I am not 100% sure that matters, but that is something to keep in mind. Clearly, if you increase these numbers here and say maybe it's higher, maybe they get closer to the midpoint of their guidance, then that increases you up to $10 per share. And again, there's upside for all of these because we're using midpoints of their guidance and bottom points. So all kinds of stuff here just gives you a range of possible outcomes. If we also throw in, let's say they have to do another 90 million shares for train 5 equity, final shares outstanding of 520 million for the company once they get all this all said and done, and they fund the company through to operations. If they were to then get train 5 starting in, let's say, 2032, put that all in there, midpoint of their guidance, that gets you to sort of an at FID. If they were to FID all these today, fair value right now of $12 per share if they had the whole facility. Again, that's not the state that they're in, so I'm not saying they're worth $12 per share intrinsic value today, but if you think those things are all likely, that is what your upside is looking at. And again, if you go all the way out and you say what does it look like for 2032 price to free cash flow, you are looking at numbers that are a fair bit higher than where the stock is trading today. And again, that's quite a ways to wait for your return, but not unreasonable that you could see I think a 3x or even a 4x based on some of this stuff. And again, there's so many variables that could make it my projections or my model more positive or more negative, but that is hopefully gives you an idea of what you can expect. One other thing, sorry, that I meant to go through before and I didn't. I've mentioned to a couple people that one of the things I thought might have been a bit of a hindrance was the company hadn't yet set up performance stock units, right? These restricted stock units that vest on an event for train 4 yet. If you look at last year's disclosed compensation for executives, they only had train 3 performance units. And now, with this year's proxy, surprise, surprise, we see Train 4 performance stock units here. And so these are stock units that will vest in part when Train 4 hits a positive FID and then vests, I think, a year and on the 1 and 2 year anniversaries of that if they're still working at the company. And so now that we see these, I think everything is in place with the incentives for executives to get this done. As we saw for Train 3, and I would expect once they get Train 4 to a positive FID to see Train 5 PSUs to show up in similarly large amounts. I also wanted to just call out, if you aren't aware of this, they have a good chunk of these other ones which are total stock return PSUs, and the majority of those total stock return PSUs, 75% of them, have to hit these particular thresholds by I want to say it's the middle of 2026. I think the end of August 2026, and so this is in a roughly a 2 year time period, slightly more than 2 years. If they don't get the stock price above $11, they do not get any of those total stock return PSUs. If they can get it, and they won't get all of them unless they get the stock above $20. Now, the executives do not control the stock price, but this gives them enough of an incentive to make pretty good decisions because they are going to be getting, again, another hundreds of thousands of, at least for the CEO, hundreds of thousands, sorry, it's this line, more stock units if he can get stock to be, pretty high, above $20 at least. So it's just good to see that management has basically the same incentives as the rest of us, right? And these numbers are substantial relative to their cash compensation. The cash compensation is a lot, don't get me wrong, but these numbers are still give them significant upside. So that, I think, is mostly what I wanted to go through. I don't see any questions or comments on the chat, so I'll give it just a minute there in case anybody has anything, but otherwise I am going to hop off because that was all the material that I wanted to go through today. I appreciate Walkaza, Transient Stacker, hop on the stream. I saw there were a couple more folks around the stream. No comments though, so I'm not quite sure who they were. I will, for anybody who is still watching, I will call out and say I do my streams try to do every Sunday, Sunday afternoon, usually around this time, usually on 4 or 5 p.m. Eastern US time. Usually I'm covering a stock that I'm interested in or that one of my viewers is interested in and has asked me about. So that is what I try to do. Again, I try to hit this as many Sundays as I can that I've been trying to be pretty consistent with. I will post it a couple hours ahead of time on YouTube and on X as well. And checking the chat, I still don't see anything, so I don't want to waste any of your time. Thank you very much for watching today. I really appreciate it, and I'm going to hop off then.